Well, with their take on what to do with your money after a day like today, our market bull, Mark Matson, our market bear, Jamie Cox. So, Mark, okay, it was a day for the bears. We're coming to you first for the opposite view. Why are you bullish in the face of such selling?
Well, it's down markets are never what destroys portfolios in the long run. It's always panic. Remember, if you're an investor, the next 100% move is up. You need to be in it for the next 20 years and not the next 20 minutes. And anyone that tells you that they know what's going to happen in the next 12 minutes or 12 months, you need to run, fire them, as a matter of fact, because no one can tell you exactly what's going to happen. And if they did, they would keep it to themselves.
All
so
right,
don't get caught speculating and gambling on the short run.
All right, that's a fair point indeed. Jamie, UBS, research firm, so not necessarily trading off this, although some of their team may be saying the global bear market has already begun. Do you agree, or is that language still too early to call?
That was a 39-page report. It has a lot of back and forth information. I think it all boils down to what happens to the spread between 10s and 2s. If the yield curve flattens or inverts, I think we are looking definitely at a recession. But to talk about the market specifically, I don't think there's any question that we've been in sort of a negative market now for about 7 or 8 months. So I'm not overly bearish. I just think people need to be defensive here and concentrate on dividend-paying stocks. I think that most investors should be there anyway, but if you have been, taking too many bites at these high-flying stocks like Netflix and Amazon and others, you probably ought to take some money off the table and put it in things that have good cash flow and dividends, because this is probably going to be a very volatile year, and you're going to need to rely on that cash flow to make money.
So Jamie, I hear what you're saying. It's also a question of value. Now, presidential candidates also taking note of this market sell-off and what's happening in China. In fact, Governor Kasich spoke about the lack of a truly free market there on Fox Business.
I want to say one thing about this whole China thing. What we're facing there is a government that never let the markets work. And the world is paying a price. They got to come clean, because they're going to have to let this thing work out. They can't keep manipulating things, because it just doesn't work. Doesn't work for them, doesn't work for the world, and frankly, it affects our companies, as you well know.
Donald Trump as well telling the New York Times editorial board he would impose a 45% tariff on Chinese goods coming to the U.S. Mark, is that realistic or even feasible?
Well, I'm never one for protectionism. I believe in free markets, but it shouldn't be a surprise to anybody that China is not a free market. They're communists, guys, so it shouldn't be a surprise that their economy could suffer. Now, we have globally diversified portfolios. I think it's important in volatility like this. We have less than 2% in China. We're in 45 different countries with 12,000 stocks. Diversification is your friend in volatile markets.
Okay, and as you said, it is a communist country, but it seems like they try to have one foot in a capitalist society, one foot in a communist society, and for the moment it is clearly backfiring. Spinning forward to tomorrow, my colleague Cheryl Casoni mentioned this. We're going to get the first jobs report of the new year. So, Mark, back to you, our market bull. Jamie, market bear, I'm going to ask you both the same thing. Could this data set change your outlook? Mark, to you first.
Absolutely not. Look, all of the knowable and predictable information is already in the price today. The only thing that's going to change prices going forward is unknowable and unpredictable events. No one has a perfect crystal ball about what that jobs report's going to be. What I want investors to do, if the market does go down, it's already down, is to think of it as an opportunity. Buy more now when the prices are low. Take some of your fixed income and buy it, because you need to be looking at the next 5 and 10 and 20 years, not the next 10 minutes.
All right. Thank you both. Mark Matson, Jamie Cox with me there.